Imagine that you decided to move to another city, so you recently sold your house and is now on your way to the airport to fly to your new hometown. When you get to the airport, you're told that the money from your house sale is not enough to buy a plane ticket. And when you instead try to take the bus back into town, you cannot afford the bus ticket either. Crestfallen, you sat down on a cafe and ordered a cup of simple black coffee, which is all you could barely afford. This was just in time because when you're done and ready to leave, the price of coffee has now risen to more than you had. This might sound like a fairy tale, but this is exactly what happened in Germany, or more exactly in the Weimar Republic, just shy of 100 years ago. Yeah, except that they were probably taking the boat instead of the airplane in those days. In October 1923, prices were increasing by 29,524%. This corresponds to an inflation of 19% per day. And this is what we call hyperinflation. Moderate inflation is good. The inflation measures how much things we buy increase in price year by year. Or as the Fed would put it, inflation is the increase in price of goods and services over time. It's like a basket of goods and services where the price is compiled every year, and when we compare the prices of these baskets from year to year, we get the inflation rate. Moderate inflation is best. It helps to drive the economy forward, because if we know that the item we want to buy will be more expensive next year, we would rather buy it immediately than wait until the prices are higher. We don't want the opposite. Deflation. But if money becomes less valuable when we have inflation, why is deflation not good then? If money becomes more valuable? It may seem good at first, but for the economy as a whole, it's not good. The economy is driven by the fact that we buy goods and services. If money becomes more and more valuable, we will wait to buy because we know that if we wait, we will have even more money to buy for tomorrow. If your 10 is enough for a pack of unicorn band-aids today, and your money is constantly becoming more valuable, you will be able to buy 2 packs tomorrow. Then you better wait until then to buy them, but then you realize that you can buy 3 packs the day after tomorrow, so you wait a little longer, and so on. If you're not bleeding right now, of course, because then you may need the band-aids immediately. But you could also use those dull brown ones that you already have at home. And the result is that the unicorn band-aid manufacturer will not be able to sell as much band-aids and has to maybe cut staff, and the economy as a whole suffers. So inflation is better. But if the inflation becomes too high, it's not good either. Then the money loses value so quickly that they become useless and are better used to light fires or as materials for bags, like these ones that are made of Venezuelan bolivar. We saw this in Germany in the early 1920s, it happened in Zimbabwe, and most recently in Venezuela, and in several other countries. And what does these countries all have in common? Well, the governments have printed lots of new money to cover their expenses. And when there's more money in circulation, prices will rise. It's all about the classic economic relationship between supply and demand. When people have more money, most people will want to buy more things. Let's say that you're super eager to buy this Toblerone, but you're not the only one who is. When everyone rushes to buy, the supply of Toblerone will go down. There will simply not be as many Toblerones left to buy anymore. So the sellers will then increase their prices or reduce the size. So we end up with something like this. And then you're back to plus minus zero, you could say. You have more money than before, but you still can't buy more because the prices of the goods you desire have also gone up. And this is how inflation always works. But when inflation rises too quickly, when we have hyperinflation, then the inflation will start to drive itself. When sellers know that the value of money drops so fast that the item is not even worth the same thing in the evening as they were when the day started, they will try to take this into account when they're setting the prices of their goods for the day and raise just a little bit extra, just in case, so they won't have to sell at a loss. Of course, this only increases the inflation even more and drives it further. Okay, so moderate inflation is good, deflation is bad, and printing money is bad because we risk getting hyperinflation. Ring any bells yet? What have you been seeing during the whole crisis? Well, the United States that has poured out money and let the prints go warm. And the latest inflation figures from the US came in at 4.2%, which is the highest figures we've seen since 2008. And these figures already caused the stock market to react. So how bad is it really? And why did the stock market react in this way? The first thing that will happen if inflation continues to rise is that the US will need to raise their interest rates to avoid inflation getting out of control. And this will probably have several different effects. When interest rates get higher, it becomes more expensive to borrow. You and I will not have as much money left, if you, like me, have loans, because we have to pay higher interest rates. Then we will not be able to use as much of our money to buy stuff, and then inflation will start to go down again. Companies will also not have as much money left in profit after interest rates are paid, and will not be as likely to take out new loans to invest in more growth. And less profit and less growth means the share prices should fall. Higher interest rates will also attract people from the stock market to savings account, where they will get higher returns when the market interest rates are higher, to less risk. Or at least this is what people think. Because it's not really only the matter to just look at the interest rates, but you also have to compare the interest rates with inflation to see how much you're actually getting. In a scenario with a low interest rate, you may get, say, 2% in interest on your savings account. And in a scenario with a higher interest rate, you might get 5%. So this sounds better, right? But in the low interest rate scenario, the inflation was at the same time only around 1%, which gives you a real interest rate of about 1. And in the higher interest rate scenario, the inflation was also at 5%, which in reality means that you would receive 0% in interest. So you can not only look at interest rates, but you also have to compare this with the inflation as well. And this is exactly the same with stocks. When inflation is high, you can be deceived to believe that the returns is higher, when in reality you may even lose money because the inflation is even higher than that. Usually I say that you should buy stocks to protect yourself against inflation. But this applies when inflation is lower and predictable. The worst thing the stock market knows is unpredictability. So when I looked at how the stock market has done historically under different inflation rates, it looks like it has gone down more often when inflation has been higher. Now it's still debated if this is a causality. Research points to that it is. But this is how it looks like anyway. Now maybe you're watching this from anywhere else in the world and are wondering how the US inflation affects you. Do you need to care about this? Yes, you do, because first of all, US still runs the global economy. Even if you're not invested directly in the US, but in, for example, a global fund, around 60% is de facto in the US. So if the US stock market goes down, you will lose money in this case. Another likely scenario that could happen is that the dollar exchange rate goes down. This is because the forex market is one of the most efficient financial markets, and no currency has been better to own in the long run than anyone else. So if the interest rates in US goes up by 5%, say, and the interest rate in, say, UK are 1%, then it would be a good idea to borrow money in the UK and then put it into a savings account in the US. We would get 4% risk-free returns, huh? Now, just like how we come up with this very clever idea, every single bank will also start moving a lot of money to the US. So we would get less money in the UK, and that would drive up the pound exchange rate compared to the dollar. So money invested in the United States can therefore both take a beating from the stock market and a weaker dollar. However, inflation is not, of course, the only factor that governs the exchange rates. But what if you don't have any money invested in the US or global funds? Well, the US economy is still the largest in the world, and many other countries are depending on it in one way or another. And in addition, many countries are dependent on the dollar, either as their own currency or their currency is pegged to this, so the exchange rate of their currency is following the dollar. There are three major reasons why the US economy is affecting the rest of the world. First of all, 20% of all countries has the United States as their primary export destination. So if the economy slows down in the US, it could have a major effect on these countries as well. Even if you yourself are not directly invested in the US stock exchange, there are still very many other people in the world that are, both retail investors and other states. And if things start to get worse in the US stock market, a lot of money will be lost worldwide. And this will indirectly affect you even if you don't lose anything yourself. What happens in the US stock market also spills over to other stock markets, not the least because when you see losses in one market, you become more cautious with all your investments in other markets as well. And also, of course, companies that export to US will not perform as good. The United States is also both the world's largest consumer and producer of gas and oil. So if the US economy begins to slow down, it could have a major impact on commodity prices worldwide. Overall, it's been concluded that if the US economy grows by 1%, it will lead to an increase of 0.8% in other developed countries and 0.6% in developing economies. So a pretty big impact, I would say. So will we see rising inflation rates, or was this just a one-off event? There are some indications that we will see higher inflation in the US in the future. Among other things, Warren Buffett, the legendary investor, says that he sees a large increase in inflation in his businesses, and many agree with him. On the other hand, there are also indications that indicate that the stock market has overreacted to the latest inflation figures and that what we are seeing is more of a temporary peak. In part, the inflation measures is a comparison year on year. And those of you who remember the spring of 2020 may remember that it was anything else but normal then. The prices of many goods went down temporarily. So comparing with last year's numbers now, when some of the goods are harder to get a hold of, may not give you a completely fair picture. In some countries, the inflation measurements have even partly had to be based on estimates because our consumption patterns have changed so much due to the current situation in the world. So maybe these numbers should be taken with a grain of salt and are not reason to panic yet anyway. As usual, no one can predict the future, but where do you think we're heading? Let's discuss it in the comments below, and I'll see you again next time.